Welcome back to the Crypto Hangout. We talk all things crypto 7 days a week. Got a new video for you guys, some more news. Bill to grant crypto firms access to Federal Reserve alarms experts. Um, Before we get into the video, go ahead and smash the like button and subscribe button and notification bell so you get notified of the next video that drops as soon as it drops, and you can stay informed. Alright, so let's get into the article. It says legislation will require the Fed to give crypto banks access to its payment rails. Some said that would be destabilizing. A wave of notoriously risky cryptocurrency firms could one day be integrated into the traditional banking system under a little-known provision in a new bill that is raising alarms among financial experts about potentially destabilizing consequences. The provision, part of a sweeping proposal to regulate crypto industry that Senator Cynthia Lummis and Kristen Gillibrand introduced in June, would force the Federal Reserve to grant so-called master accounts to certain crypto firms seeking them from the central bank. The accounts give holders access to the Fed's payment system, allowing them to settle transactions for clients without involving a separate bank. Two Wyoming crypto-based firms championed by Lummis stand to benefit. Both companies, Custodial Bank and Kraken Financial, have been stymied over the last 2 years in bids to gain Fed master accounts. But financial regulators and experts say the measure's impact would cascade through the industry and beyond. The push by crypto firms to join the banking system's central plumbing comes at a fraught moment for the industry and its regulators. A steep sell-off of cryptocurrencies has erased $700 billion from the digital assets market since May, forcing a reckoning for some previously high-flying startups. One such firm, Celsius Network, halted withdrawals last month, citing extreme market conditions, as it froze as much as $8 billion in deposits. Even before the last meltdown, the Federal Reserve had been reluctant to grant master accounts to crypto-focused banks. In Custodial's case, Federal Reserve Chair Jerome Powell has cited his concerns about unleashing a tide of other crypto companies offering banking services while lacking federal insurance backstop. If we start granting these, there will be a couple hundred of them soon, Powell told Lummis when she pressed him about the matter in January hearing. Under Wyoming law, these banks can put their reserves into more volatile assets, such as corporate and municipal debt, which could prompt a run if they suddenly lose value, said Lee Reiners, a former Fed official who now runs Duke University Financial Market Center. The concern is that you could have entities with poor risk management and poor risk controls integrated into the Fed's payment system. The longer-term result could be a new buildup of systematic risk akin to what has preceded other financial meltdowns, some experts say. I'm very concerned about the idea that uninsured banks of any type would have access to Fed services and more broadly proliferate, because we've had very bad experience with non-federally insured banks in the past, said Arthur Wilman from George Washington University and an expert on financial regulation. I'm concerned they'll be systematically important, or we could end up needing to bail them out if it looks like they're going to fail. Proponents counter that giving more firms access to the central bank's payment infrastructure will have the opposite effect, shoring up the crypto economy by giving federal overseers a better view of its activity. Giving more regulated financial institutions access to the payment system reduces risk because it allows more visibility into who owes what, said Lummis' aide. And if there's a systematic crisis, if a bank were to fail, there wouldn't be as many ripple effects in the economy. Now the Fed is facing increased pressure to act. On June 7th, the same day Lummis and Gillibrand introduced a bill, Custodial sued Federal Reserve and its Kansas City Regional Bank in federal district court in Wyoming, accusing it of unlawfully delaying action on its application 19 months after it was filed. The company, founded by Morgan Stanley veteran Caitlin Long, set up shop in Wyoming in 2020 to take advantage of special rules the state adopted the year before to attract firms looking to mix traditional banking activities with crypto transactions. Shortly after securing its state charter, it applied for a Fed master account. In the months since, what has resulted is an unaccountable Kafkaesque process that has and continues to inflict grave and irreparable harm on Custodial. The company has cast itself as a David taking on Goliath of Wall Street. If federal regulators continue to hold back innovators like Custodial, they are only letting the big banks catch up and gobble up the market, Custodial spokesman Nathan Miller said. That leaves consumers with fewer choices and higher bank fees at a time when American families are struggling with inflation and economic security. Federal Reserve declined the comment. Okay, Kraken, for its part, is primarily known as a crypto exchange, operating the second largest such trading platform in the United States. But an affiliate known as Kraken Bank in 2020 secured the first charter under Wyoming's carve-out for crypto banks, pledging to provide clients a seamlessly banking gateway between digital assets and traditional currencies. When Kraken Bank applied for its own Fed master account shortly thereafter, a united front of banking lobbying groups pushed back, In a letter to the Fed, the coalition warned that Kraken's business model presented novel risks, pointing to the company's lack of federal oversight as it hosts leveraged trading for volatile digital assets. Amid a stark downturn for the Kraken industry that has prompted several of its rivals to cut staff, Kraken, which is privately held, this month said it plans to add 500 employees. The Fed is in the midst of developing standards for granting master accounts, a process whose murkiness has drawn criticism from Republicans in Congress. The matter took center stage earlier this year in a partisan fight over the nomination of Sarah Bloom Raskin to serve as the federal top financial regulator. Raskin served on the board of the Reserve Trust, a Colorado parent company, when it secured a master account in 2018 after being denied after a year earlier. Loomis and other Republicans on the Senate Banking Committee pressed Raskin on whether her influence as a former Fed official would help the firm. Raskin denied any impropriety, but the episode helped sink her nomination. In its wake, the Kansas City Fed revoked Reserve Trust master account. Senator Patrick Toomey, the top Republican on the Senate Banking Committee panel, wrote to the bank in June asking for details on the decision. The Kansas City Fed rejected his request, citing the need to protect confidentiality of a private company in the bank's own process. Republicans are pushing a bigger point. As financial technology startups angle to compete with traditional banks, the Fed needs to explain its standards for doling out access to its payment rails. Loomis told Powell at a hearing in June that the process remains a black hole and said that frustration with it is at a boiling point. The Fed is considering adopting a system that would subject firms that are not federally insured or federally regulated to stricter scrutiny. Dennis Keller, president of the nonprofit Better Markets, which advocates stricter financial regulation, said the details will matter, but the approach will likely be the worst of all worlds, granting crypto firms access to the Fed's payment infrastructure without the regulations imposed on banks. The result would be the appearance of protecting taxpayers in the financial system, but not in the reality. So more crypto adoption is coming. As you can see, they're trying to figure out a way to integrate certain crypto banks into the Federal Reserve on-ramps, into the Federal Reserve system. As I told you, crypto is not going anywhere. It's here to stay. All right. This could be a good thing, could be a bad thing. They've already told you, the World Economic Forum has already told you that they want the blockchain, but they don't want cryptocurrency. Okay, and so the blockchain technology is what they want. They want to be able to see what everybody's doing, but they don't want you to be able to see what they're doing. So this is why it could have this is one of the reasons why they don't want that to integrate with the Fed, because they don't want everybody else to see what the Fed is doing. And they won't tell you that. They'll tell you that it'll have some dire consequences, etc. But that's the real reason. Alright, so comment below. Let me know what you guys think of the article. Hope you guys had a happy 4th, and see you to the next video. Peace.